All right. Good morning, everyone, and welcome to Weekly Profit Talk. We do this every single week, as the name implies, and this is every single Wednesday at 8:30 Mountain Time. That is 7:30 if you are Pacific, 10:30 if you are Eastern. Good morning and welcome, everyone, and hope that you're staying warm and safe and dry wherever it is you live in the United States. Um, this week's topic is legal tax avoidance for private physicians. And I was in the middle of my setup here, so bear with me just a second. We love these professional presentations, don't we? Okay, so this is a well-loved topic of mine, and I circle back around to this again in many ways. This is one of those things that can apply to a certain extent to people outside of the medical profession as well, but in particular, you private practitioners you've started after all of your education and your residency. You're in business and you're seeing patients, and the thing is that you are painfully aware by now that you've got a fairly legit significant is the word I want tax bite that's coming out of your income. Now there are things you can do about this, and the main thing we want to make sure is absolutely clear to you is that you do not have to pay a single penny more than absolutely legally necessary. People will often take a look at the taxes that they've completed in their home softwares and look at the numbers and figure, well, this is right, and I've withheld this much, so I'm getting this much back. And I'm talking about W-2 type wage earners. For you, the private practitioner, you have a totally different situation. Chances are, if it's your first year in business, and let's just say hypothetically that you decided to not do anything about taxes, you're making the money, you're putting the money away, and then tax time is going to come rolling around here. And it's important. This is a really good time of year to be thinking about this because in November, in about 4 months or so, you're going to have to file a tax return. And if you haven't done anything about putting money aside or sending money in quarterly payments to the Internal Revenue Service, yes, you have to do this. Not only that, but if you watch this weekly, I've already beaten this subject to death, but we'll keep circling back to it. Okay. But the main thing is this. If you find yourself hypothetically stating in a situation where you just made the money, spent the money, and then March comes around and you're filing a Form 1040, and suddenly magically you've got a tax bill of $5,000 or $6,000 that you haven't prepared for, you've got a couple of problems. First of all, you got to scare up the money and pay them. Not paying them has its own consequences. But the second thing is that you're also going to be paying more than the tax itself, because if you're not paying as the year progresses, you're also going to be looking at underpayment penalties. Now, this is a subject for another topic, which is quarterly estimated taxes. But how can we legally avoid as much tax as possible? So let's see, take a look at my slide here. So I've made these points pretty clear. You do not have to pay a penny more than dictated by the Internal Revenue Code. There's nothing wrong with you if you pay the minimum amount. The United States government is not a charity, and if you are a fan of the way they spend your money 100% of the time, then you're just not paying attention to the news. So not that I recommend watching very much news because, yeah, that's got its own problems these days. But it is, in fact, incumbent upon you and your staff, your business, your patients, and your family, that you pay the absolute minimum amount of tax possible. And the reason for this is because this increases your bottom line earnings after all other expenses. Now, there are ways that you can, in fact, legally put thousands of dollars back into your pocket as a new business. Let's say we'll continue that hypothetical into the next 3 years, and you become aware of the possibility of doing what's known as an S corporation election. So what that means is you'll file a second tax return, and you're taxed as a flow-through corporation. the income flows through, in other words, to your Form 1040, and you pay taxes for it at that point. Now, an S corporation requires that you take a wage out of your business, but your wage doesn't have to be the same amount as your net income. And as a matter of fact, it would be unreasonable to expect that. It certainly doesn't need to be over. So, what happens then is, let's say, for example, you make, and this is, I hope you're doing better than this, but $100,000 is a nice even number. And it's also under the Social Security ceiling for taxation of wages. So it gives me a good example to work with and numbers that I have memorized in my head here. So if you make $100,000, let's say, for example, that you take 48,000 of that as a reasonable compensation, or $4,000 a month. Now, again, hopefully you're doing significantly better than that. The remaining $52,000 is net income from the S corporation that's reported to you on a separate schedule, and then you include that on your 1040. That money basically is no longer exposed to Social Security and Medicare taxation, just ordinary income tax. That move alone saves you $7,000 to $8,000 a year. So that's a very simple thing that you can do, and you should be doing. In the absence of that, you're filing your business as an attachment to your 1040. They call it Schedule C, and that creates a Schedule SE for self-employment, and you're going to pay the effective tax rate of a little over 14% on every single dollar that you made into Social Security and Medicare before you pay a dime of regular income tax. Single, married, it doesn't matter. Typically, that amount of tax out of $100,000 can be over $25,000 easily. So this is the thing that you want to do: legal tax avoidance, obviously. So, one last thing is, as your empire grows and your success progresses and your business evolves, you may find, especially in the current political climate, the corporate tax was lowered from 35% to 21% back in 2017 and then put into effect the following year. With the current federal election results the way they are, and I'm not here to talk about politics, but basically the people that put that in place are coming back into power in January, and it's highly unlikely that the 21% is going to increase in the near future. Now, I don't have a crystal ball. I don't know for sure. Things are unwritten, certainly. But at 21%, consider, let's say, for example, now that you're doing well and you're netting about $500,000 a year, you're going to be in a 35 or 37% tax bracket, depending on other things. Would it be advantageous for you to be taxed on your business income at 21% instead? Yes, it would. But there are certain things that you need to consider. For one thing, that corporation needs to pay you a wage, just like your S corporation did. Naturally, that's where you're going to make your money from. And you don't want to take all of your money in corporate dividends, because that has its own pitfalls. So if you have specific processes in place to ensure that you're doing good tax planning, as well as also ensuring that you're planning for your income to be specific levels year after year from your corporation, it can be a very tax advantageous way to conduct your business. So that's something that you need to consider. So I'll leave you with a few final points here. You wouldn't hesitate to refer a patient to a specialist. And for that reason, you might not want to shy away from seeking expert tax help for doing some of the things that I've been talking about here. So that's what we do. And the reason it's not the reason that we come on and talk to you every single week. I'd like to share a little bit of information for you. And hopefully this is helpful while you're maybe getting your second cup of coffee or doing whatever you do on Wednesday morning. So if this has been helpful for you, certainly we appreciate that. But if you would like to learn more about working hand in hand with a non-equity partner that only has your fiscal success in mind, then reach out. We are coming to you in one of three different media, of course, Facebook, but YouTube and LinkedIn, and they all have in common the ability to write a comment and send us a message that way. Facebook in particular, we're always looking at our direct messages, LinkedIn as well. So reach out. And if you would prefer to write an email, that address is eric@owingsllc.com. And we can talk about what we can do to help you um, realize your fiscal goals and perhaps retire 5 to 10 years earlier through some very simple things that are completely moral. Okay. So, with that, we'd like to leave you with the thought that uh, you've worked very hard to get where you are in your life and doing the things that you do to serve society. You deserve to reap every possible net dollar from your business that you possibly can in a moral way, certainly. But you don't have any business paying in more than you absolutely have to the tax people. And if you live in one of 41 states that have state income tax, and that is over 80% of them, then you're basically dealing with two things. So with that, I hope this Wednesday finds you doing well and happy, and you have a great rest of the week. If you do have a chance, do something randomly kind for a stranger today. And with that, have an amazing week.